As the global economy moves closer to 2026, inflation remains one of the most powerful forces shaping financial markets, household purchasing power, and long-term investment decisions. Over the past few years, governments around the world, especially in developed economies, have relied heavily on monetary expansion, deficit spending, and debt issuance to stabilize growth, manage crises, and support financial systems. While these policies may offer short-term relief, they also carry long-term consequences, particularly for fiat currencies like the US dollar. In this environment, gold once again stands out as a proven store of value and a long-term hedge against inflation and currency devaluation. Inflation, by definition, reduces the purchasing power of money. When prices rise faster than wages and savings returns, individuals and institutions can buy less with the same amount of currency. Even moderate inflation, when sustained over time, can significantly erode wealth. For example, a currency experiencing an average inflation rate of 5% per year loses nearly half of its purchasing power over 15 years. This silent erosion is one of the greatest risks faced by holders of fiat currency, especially in an era where inflation is no longer viewed as temporary, but increasingly structural. The US dollar, despite its status as the world's primary reserve currency, is not immune to this process. Massive fiscal deficits, rising entitlement costs, military spending, and interest payments on national debt have placed the U.S. financial system under increasing pressure. To manage these obligations, the supply of dollars continues to expand. While money creation does not always lead to immediate inflation, history shows that sustained expansion of the money supply eventually weakens currency value. By 2026, many analysts expect inflation to remain a recurring challenge rather than a resolved issue, particularly if governments choose growth and stability over strict monetary discipline. Gold's strength lies in its fundamental scarcity. Unlike fiat currencies, which can be created in unlimited quantities by central banks, gold has a naturally limited supply. Mining new gold is expensive, time-consuming, and constrained by geology. This scarcity gives gold intrinsic resistance to inflation. When more currency units chase the same amount of goods and services, prices rise, but gold, whose supply cannot be rapidly increased, tends to maintain its real value. Over long periods, gold has repeatedly demonstrated its ability to preserve purchasing power even as currencies rise and fall. Historical evidence strongly supports this relationship. Over centuries, gold has maintained its ability to buy essential goods such as food, land, and labor, even as entire monetary systems have collapsed. In contrast, every fiat currency in history has eventually lost value or disappeared altogether. The US dollar itself has lost over 95% of its purchasing power since the early 20th century. While it remains powerful today, this long-term trend highlights a key reality. Fiat currencies are designed to depreciate gradually, while gold is designed by nature to endure. As inflation accelerates, investor behavior also shifts in predictable ways. When confidence in paper money declines, capital tends to move toward real assets, commodities, real estate, and particularly precious metals. Gold benefits not only from its scarcity but also from its independence. It is not tied to corporate earnings, government promises, or central bank policies. This lack of counterparty risk becomes increasingly valuable in times of monetary instability. By 2026, with global debt levels higher than ever, trust in traditional monetary systems may weaken further, increasing gold's appeal. Another important factor is real interest rates, which are closely linked to inflation. When inflation rises faster than interest rates, real returns on cash and bonds turn negative. In such environments, holding currency becomes costly in real terms. Gold, which does not yield interest, performs best when real rates are low or negative. If central banks hesitate to raise rates aggressively due to debt burdens or economic fragility, inflation may remain elevated while real yields stay suppressed. This scenario strongly favors gold over fiat currencies. Central banks themselves recognize this dynamic. In recent years, many central banks, particularly in emerging economies, have increased their gold reserves. This trend reflects a desire to diversify away from dollar-denominated assets and protect national wealth from inflation and currency risk. Central bank behavior sends a powerful signal to markets. Gold is not just a relic of the past, but a strategic asset for the future. If inflation risks persist into 2026, this institutional demand for gold is likely to continue. From an individual investor's perspective, gold offers long-term stability rather than short-term speculation. While gold prices can fluctuate in the short run, its real strength lies in its ability to preserve wealth across economic cycles. During periods of rising inflation and currency weakness, gold often outperforms cash and fixed income assets. This makes it especially relevant for long-term savers, retirees, and those seeking protection against systemic risk. In contrast, relying solely on the dollar exposes investors to policy decisions beyond their control. Governments facing inflation often choose strategies that prioritize debt management and economic growth over currency strength. This can include tolerating higher inflation, devaluing the currency indirectly, or maintaining loose monetary conditions. While such policies may stabilize markets in the short term, they reduce the long-term value of money. Gold serves as a counterbalance to these risks. Looking toward 2026, the debate between gold and the dollar is not about immediate replacement, but about relative strength. The dollar will likely remain dominant in global trade and finance, but dominance does not guarantee purchasing power. Gold's role is not to replace currency in daily transactions, but to protect wealth when currencies weaken. In an era defined by inflation, debt, and monetary experimentation, gold's long-term edge becomes increasingly clear. In conclusion, persistent inflation and ongoing currency devaluation reinforce gold's importance as a store of value. While the US dollar remains powerful, its purchasing power continues to decline over time due to structural economic forces. Gold, supported by scarcity, history, and global trust, offers protection against these trends. As 2026 approaches, inflation is likely to remain a defining challenge in that environment. Gold's long-term edge over fiat currency becomes not just relevant but essential. As the world approaches 2026, it's one of the most significant and underappreciated threats to financial stability is the unprecedented level of global debt. The United States, along with many major economies, is carrying record-breaking debt loads that continue to grow each year. While debt has long been a tool for economic expansion and crisis management, the scale and speed at which it has accumulated in recent decades raise serious questions about long-term sustainability. As interest costs rise and refinancing becomes more expensive, the burden of this debt places increasing pressure on fiat currencies, particularly the US dollar. While strengthening the case for gold as a debt-free financial refuge, the United States government now operates in a fiscal environment where debt is no longer cyclical but structural. Budget deficits persist regardless of economic conditions, driven by rising entitlement spending, defense costs, interest payments, and political resistance to austerity. Even during periods of economic growth, deficits remain elevated, forcing the government to issue more debt simply to maintain operations. By 2026, the cost of servicing this debt is expected to consume a growing share of federal revenue, limiting fiscal flexibility and increasing reliance on monetary support. Rising interest rates significantly worsen this problem. When rates were near zero, governments could borrow cheaply and roll over existing debt with minimal cost. However, as inflation forced central banks to tighten monetary policy, borrowing costs increased sharply. Each percentage point increase in interest rates translates into hundreds of billions of dollars in additional debt servicing costs over time. This creates a dangerous feedback loop. Higher rates increase debt costs, which lead to more borrowing, which then adds pressure to monetary policy and currency stability. The US dollar sits at the center of this dilemma. As the world's reserve currency, it benefits from global demand, deep liquidity, and trust in US institutions. However, reserve status does not make the dollar immune to debt-driven erosion. In fact, it can delay consequences rather than eliminate them. The ability to issue debt in one's own currency reduces immediate risk but increases long-term vulnerability, especially when debt levels grow faster than economic output. By 2026, markets may become increasingly sensitive to the imbalance between U.S. debt growth and real economic expansion. Debt sustainability is not just about total debt levels, but about confidence. As long as investors believe a government can manage its obligations without resorting to excessive money creation, the currency remains relatively stable. Once confidence weakens, however, currency value can deteriorate rapidly. If investors begin to doubt the U.S. government's ability to control deficits or stabilize debt, demand for dollar-denominated assets may decline, putting downward pressure on the currency. This is where gold's unique role becomes critical. Gold is not a liability, does not represent someone else's debt or promise to pay. Unlike bonds, currencies, or financial instruments, gold carries no counterparty risk. Its value does not depend on fiscal discipline, political stability, or central bank credibility. In an environment where debt levels threaten monetary stability, this independence becomes one of gold's greatest strengths. Historically, periods of excessive government debt have often coincided with currency debasement. Governments facing unsustainable debt burdens tend to choose inflation over default, as inflation reduces the real value of outstanding obligations, while outright default is politically and economically damaging. Gradual devaluation through inflation is often seen as the less visible option. This strategy, however, erodes the purchasing power of currency holders and undermines long-term trust. Gold, by contrast, benefits from this process as investors seek assets that cannot be inflated away. By 2026, global debt concerns will not be limited to the United States. Europe, Japan, and many emerging markets face similar challenges, creating a worldwide environment of fiscal stress. When multiple major economies struggle simultaneously, the traditional assumption that one currency will always serve as a safe haven becomes less reliable. This broad-based debt problem strengthens gold's position as a universal store of value. Independent of any single nation's balance sheet, central banks appear to recognize this reality. In recent years, many have increased gold holdings while reducing reliance on foreign currency reserves. This trend reflects a strategic response to debt risk, currency volatility, and geopolitical uncertainty. Gold's role as a reserve asset is being quietly reinforced, not replaced. By 2026, continued accumulation by central banks could further support gold prices and signal declining confidence in debt-heavy monetary systems. For investors, the contrast between gold and the dollar becomes especially clear during debt-driven market stress. While the dollar may experience temporary strength during liquidity crises, its long-term trajectory is constrained by fiscal realities. Gold, meanwhile, does not require economic growth, balanced budgets, or political cooperation to retain value. It simply exists as a finite, globally recognized asset. Another important aspect is intergenerational impact. Rising debt effectively shifts financial burdens from current populations to future ones. This long-term imbalance increases the likelihood of policy interventions that weaken currency value over time. Gold serves as a tool to protect wealth across generations. It's offering continuity in a financial system increasingly defined by short-term solutions and long-term liabilities. In conclusion, record levels of government debt represent a structural challenge to the U.S. dollar as we move toward 2026. Rising interest costs, persistent deficits, and growing refinancing risks place increasing pressure on fiat currencies. While the dollar remains dominant, its foundation is increasingly debt-dependent. Gold, as a debt-free asset with no counterparty risk, stands in direct contrast. In an era where debt sustainability is questioned and monetary stability is uncertain, gold's role as a financial refuge becomes not just relevant but essential. Central banks play a decisive role in shaping currency, strength, interest rate cycles, and overall financial stability. As the world moves closer to 2026, the contrast between monetary policy decisions, particularly interest rate management, and the growing accumulation of gold by central banks, reveals an important shift in institutional behavior. While higher interest rates can temporarily support the U.S. dollar, long-term policy realities suggest potential weakness ahead. At the same time, central banks' increasing preference for gold signals a strategic hedge against future monetary and financial risks. Interest rates are one of the most powerful tools central banks use to influence currency value. When rates rise, currencies tend to strengthen because higher yields attract global capital. This has been evident in recent years, as aggressive rate hikes by the U.S. Federal Reserve supported the dollar by making U.S. assets more attractive to foreign investors. Higher rates increase returns on bonds, savings, and dollar-denominated investments. Reinforcing demand for the currency in the short term, However, this support is often temporary. High interest rates come with economic trade-offs. They slow borrowing, reduce consumer spending, increase debt servicing costs, and can weaken economic growth over time. As rates remain elevated, pressure builds across governments, businesses, and households. By 2026, many economies may find prolonged high rates unsustainable, forcing central banks to pivot toward rate cuts or renewed monetary easing to prevent recession or financial instability. This is where the long-term outlook for the dollar becomes more complex. Rate cuts, while supportive of economic activity, often weaken currency value by reducing yield advantages. When interest rate differentials narrow, global capital becomes more mobile, and demand for the dollar can soften. If easing measures include renewed asset purchases or liquidity injections, the dollar may face additional pressure through increased money supply and inflation expectations. Gold responds very differently to these policy shifts. Unlike currencies, gold does not pay interest, which often puts it at a disadvantage during periods of rising rates. However, once rates peak and expectations turn toward easing, gold tends to regain strength. Lower interest rates reduce the opportunity cost of holding gold, while monetary expansion increases concerns about currency debasement. This dynamic creates a powerful tailwind for gold during light cycle and post-tightening phases. Central banks appear to be positioning themselves accordingly. In recent years, many have significantly increased their gold reserves, reversing decades-long trends of reliance on fiat currencies alone. This accumulation is not driven by speculation but by strategic risk management. Gold provides diversification, stability, and independence from foreign monetary policy decisions. By 2026, this trend is expected to continue, reflecting long-term institutional confidence in gold's role within the global financial system. One key reason central banks favor gold is its neutrality. Unlike foreign currencies, gold is not tied to another country's political or fiscal decisions. Holding large reserves of dollars exposes countries to U.S. monetary policy, sanctions risk, and geopolitical leverage. Gold, by contrast, carries no such dependency. It functions as a universally accepted reserve asset that cannot be frozen, devalued by policy, or affected by interest rate decisions. This shift becomes especially important in a world facing increasing geopolitical fragmentation. Trade tensions, financial sanctions, and strategic competition have encouraged many countries to reduce over-reliance on any single reserve currency. Gold fits naturally into this strategy. By increasing gold reserves, central banks can reduce exposure to currency volatility while strengthening financial sovereignty. This behavior suggests a gradual but meaningful rebalancing away from exclusive dollar dominance. Another factor influencing this trend is confidence. Central banks operate with long-term horizons, often spanning decades rather than quarters. Their accumulation of gold reflects not short-term market timing, but deep structural concerns about the future stability of fiat currencies. Persistent deficits, rising debt, and repeated cycles of monetary expansion undermine long-term confidence in paper money. Gold, with its limited supply and historical role as money, offers a form of insurance against these risks. For the dollar, this institutional shift presents a subtle but important challenge. Even if the dollar remains dominant in global trade and finance, reduced incremental demand from central banks can limit long-term support. Currency strength depends not only on interest rates, but also on trust and reserve preferences. If central banks continue to favor gold as a reserve asset, the dollar's structural advantage may gradually weaken. It is also important to note that central bank gold purchases tend to occur quietly and persistently. Unlike speculative flows, these purchases remove gold from the open market and place it into long-term storage. This reduces available supply and supports prices over time. By 2026, sustained central bank demand could significantly influence gold's valuation, reinforcing its role as a core monetary asset. The contrast between interest rate policy and gold accumulation highlights a key divergence between short-term and long-term thinking. Interest rates are tactical tools, adjusted frequently in response to economic data. Gold accumulation, on the other hand, reflects strategic planning based on long-term risks. While rate hikes may temporarily strengthen the dollar, they do not resolve underlying structural issues. Gold addresses these deeper concerns directly. In conclusion, while higher interest rates can provide short-term support for the US dollar, long-term monetary realities point toward eventual easing and renewed liquidity measures. These shifts tend to weaken fiat currencies over time. Meanwhile, central banks are increasingly turning to gold as a stable, neutral, and debt-free reserve asset. This contrast in institutional behavior suggests that as we approach 2026, gold may gain relative strength over the dollar not because of speculation, but because of strategic trust, diversification, and long-term monetary prudence. As the world moves toward 2026, geopolitical tensions, trade conflicts, and regional instability are expected to remain persistent features of the global landscape. From ongoing conflicts and power rivalries to economic sanctions and supply chain disruptions, uncertainty continues to shape investor behavior. In such environments, financial markets often experience heightened volatility, and capital flows shift rapidly in search of safety. Historically, these conditions have favored gold over currencies, including the US dollar, reinforcing gold's role as a primary safe haven asset during periods of global stress. Geopolitical risk creates uncertainty because it disrupts predictability. Investors rely on stable political systems, clear trade rules, and peaceful international relations to forecast economic outcomes. When these foundations weaken, confidence in financial assets declines. Wars, diplomatic standoffs, and trade disputes can affect energy prices, commodity supplies, inflation levels, and global growth prospects almost overnight. As uncertainty rises, investors become less willing to hold assets exposed to political decisions, policy changes, or potential sanctions.